multiple topics we are covering today on tax. I will Manoj Bhai to take us through what all is what all is there during the.
Welcome everybody. Good afternoon to all of you. I'll just say a few words. Excellent series of roundtables since over a decade. BFSI and capital market. Always latest topic, latest developments are discussed among people from industry, people from profession, CEOs, CXOs, directors, heads of verticals, and people contributing significantly with deep domain knowledge on those special issues, because it's a time of specialization. And as suggested by many members, several topics were suggested. So the theme for the day is latest developments on financial planning related issues, financial planning, investment planning, tax planning. There are hot developments on LRS since the last couple of months. So views of all taxpayers are invited, and some developments have taken place. And also tax season is on. Deep dive into mutual funds, deep dive into PMS, individual. Latest on regulations. The role of CFO has been changing in the eyes of all the stakeholders, particularly regulators. NFRA, SEBI, there are latest circulars. So they will be also discussed with length along with real life case studies. So I would request Rohit to say a few words about our experts. Rohit?
Yeah, sure. Thanks for the opportunity. I am very delighted to actually talk about Sunil Kothare. He is a stalwart in taxation. He has been there in industry, I think, for more than 4 decades. I can, for more than 4 decades. So he will take us through the basic things about taxation. He will also touch upon the aspect on tax and related issues. The second in line tax is Sunil Gidwani. He also is a tax expert. He is with Mangla and associate. Both together will, I believe, will do justice to the topic. The subject is very open. They have industry perspective, the cases and industry. So, looking forward to a fruitful discussion. Other person of
Yeah.
Sunil.
So I will also add, we have Naresh also.
Naresh,
He is a part of our brain trust, and it's a delight. There are four of us specialists with deep knowledge on taxation, and when we have such a delightful panel, no question on tax will go unanswered. I think we are confident of that. And in case for fine print that is not answered today, but I know you'll get answer within 24 hours or within a few days. Even it is a deep, intricate question, so you will get it, and so you can always put it on the message, and you will get that. And with this, we have quite senior people from industry. Here I can see, Citibank, I can see CRISIL, lots of people are there. So over to you, Mr. Sunil Kothare.
Thank you. Good afternoon, everybody. So let me dispel some of the notions. And Manoj has been very kind and generous in his praise. As far as I understand, and Sunil and Naresh endorse my view on this point, there is no simple question in tax. I mean, all of you are chartered accountants, there is no simple question. And therefore, if we were to give an assurance that we will give all the answers to all the questions, we may belie your expectation. So don't have that expectation, notwithstanding the introduction. So Manoj, we do apologies to you.
And with this, I would just mention, I would thank our chairman, Mr. Arpit Kabra, to have pointed out there is a recent publication on GIFT City handbook. And incidentally, we are discussing lots of development took place this week on GIFT City. After the program was announced, and we always cover, we'll be discussing that. And this is a publication available, very interesting publication. So one can always look at it as a good reference. So it's available at the publication thing, latest publication. And this is a part of a series of publication. And for us also, GIFT City also is a series of topics we'll be covering. It's a part of global finance. Yeah, Sunil. Well, let them take their own call, whether it's a part of international affairs or whether it's a part of branch affairs or this thing. So, but I'm sure there'll be many members there. Members will be shifting there soon because of huge demand and recruitment from many of the foreign banks.
And in audit, they have hired 40 people there.
But I can say for sure, we will service their requirements on domain specialization area. Any issue, whether it is stocks of top 50 US companies being traded on GIFT City, or whether it is indices, or whether it is tax intricacy, or whether it is bond markets when our indices get included, we are Roundtable will certainly address all issues. Good, you raised that point, huh? These opportunities for members.
So, having given the preliminary comment, by all note, able to ask one question. Let me share with you that this is a roundtable, as we said, and therefore, room for discussion. It's not one-way traffic. But in the interest of, say, harmony of discussion, what I plan to do is, first I will do a brief introduction of LRS, because to apply TCS on LRS, we have to understand what is LRS. Then we go to TCS on LRS as it came a year and a half ago. Then what changed in this budget? Then what changed in the last week of June? And how it will feature going forward. That's the way I intend to cover it. If any points come to your mind, I would suggest rather than kind of pausing me at each stage, allow me to complete my say. You can ask all your questions to the best of my ability with no guarantee of accuracy. I will try to answer those questions. And of course, Naresh and Sunil both are here. So they will supplement, correct in whatever manner they wish to, and not to exclude any of the others, of course, because each one of you will have your individual experiences. So let's go back to what is LRS. The full form, as you know, is Liberalised Remittance Scheme, and it was introduced for the first time in 2004. When, unlike pre-2004, when every time you wanted to remit money, you had to consider whether it was a capital account transaction, current account transaction, etc. And banks had to then evaluate, you had to actually go to the branch and do remittance. The then government decided that, look, given the foreign exchange balances that are available in India, and of course they were not at the close to $600 billion that we have today, they were much smaller. The government said we will allow each individual country, each resident in the country, to remit annually, and initially January to December, not more than $25,000, covering all kinds of remittance. That was the framework. Then, as time passed, with the experience and learning on the part of bankers, the experience and the report that the RBI got, and looking at the following scenario, 25,000 became 50,000, 50,000 became 100,000, then became 150,000 US dollars. Then it was brought back to $50,000 in between, then it went to $250,000. That's how it has progressed. Where we are today is, number one is a resident individual under FEMA, underlying resident and individual, which means you are a resident of FEMA. It is not necessary that you are resident of income tax. And those two tests are very different, as you know. Resident under FEMA talks about physical presence in the preceding financial year, where resident under income tax has a different connotation. It talks of presence in income during the relevant financial year, not the prior year. Second, it is applicable to individuals, which means can HUF do it? And the RBI has clearly stated that in its FAQs. Can an LLP do it? The answer is no. Can a partnership firm? The answer is no. Can a cooperative society do it? The answer is no. Can a non-profit organization avail of LRS? The answer is no. Can a company do it? The answer is no. So it is limited to individuals. And as chartered accountants, we always tend to ask, is it necessary that the individual must be major, minor minds, clubbing of minors income is there? So is LRS available to only major persons or is it available to minor persons? The answer to that is it is available to both major and as long as the individual concerned is a resident. Then because financial services study group or roundtable, the question that comes to our mind is, I don't have money in my bank account. Can I borrow from somebody and do LRS? Broadly, the answer is no. There is one exception. There are two exceptions that I can recall. One is that you can borrow for the purpose of education. Second is you can borrow for the purpose of otherwise for things like investment outside. I want to buy shares on the New York Stock Exchange. Can I borrow? The answer is no. Can I use LRS for any purpose whatsoever? So I'm going for a family vacation and one of the points where I stop is Nauru in the Pacific or it is say, Las Vegas in US. Can I use LRS for gambling? The answer is no. Can I do remittances to Mauritius or to Pakistan? The answer surprisingly is yes. The RBI has said surprisingly yes. But they have a word of caution that under LRS you cannot remit to countries which are not compliant or non-cooperative under the FATF regulations. Financial Action Task Force, which is an international body which regulates how transparency is there for tax matters. You cannot use LRS for an organization which is involved in terrorist funding. So these are the broad parameters, and as we go along, we'll talk about it. So why I'm mentioning that this is applicable to individuals and there are restricted usages. Sometimes clients will come across and say, no, I want to use this for this matter. The answer has to be known to the chartered accountant. And you will be surprised that when the TCS provisions first came, and I was one of the participants at one of the study circles where I'm a member, they assumed that as a banker I should know all the answers, which I did not. But one simple question asked by almost 80% of participants: what do I do for TCS for non-residents under this 2061G? I said it doesn't apply to non-residents, it applies to residents, and by and large, barring a few exceptions, there will be convergence between resident under FEMA and resident under income tax. There would be some stray cases, but those did not come up for discussion. So, what rate should I apply, surcharge and cess, etc.? Those questions by and large are not there. Then we come to what exactly is it that prompted the government to bring LRS. All of you are now seeing for your clients or for yourselves your Form 26, your AIS, your EIS. So you are familiar with the wealth of information that the government has got. And this is the last couple of years. This year it is more refined than it was earlier because 100 rupees savings account interest is being reported. Earlier it was not that way, only about 5,000 was being reported. But as part of the government's project called Insights, 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 the government said that there are certain flows which don't get recorded in any of our systems, mainly flows that are non-products, number one. Number two, and this is somewhere a connection between what we all know as Form 15 the data on forex remittances as being by the RBI, as being by the Department of Economic Affairs, and as available with the Income Tax Department, the three were divergent to such an extent that nobody could reconcile those numbers. So then Form 15 CSE was used to replace the earlier forms. And then those were developed from time to time. There came the discipline of Form 15 CC reporting, but still the government found that that data was not sufficient, and therefore they said that if there is individual remittance, there are 33 remittance codes for which 15 CSEB forms are not required. So why not we introduce a mechanism where when you remit the funds, there will be a track either by way of a tax collection at source or by way of reporting that this was a transaction, but there was no tax collection at source. And that's how when they framed the legislation, they thought roughly $10,000, which is 70 of doesn't matter that the rate then was 72 and 75 rupees per dollar. They said up to 7 lakhs. Of course, they did not ask us. They said $10,000 is okay. Almost retail remittances are all below $10,000. I said generally yes, they are below $10,000. We were not aware why they were asking that question. And then it came that in 2021, TCS or LRS with the introduction of 206C1G, it was not meant to be a tax collection mechanism for the government because they did not expect huge revenue. It was more like a tracking mechanism. As usual, people who were supposed to do the TCS made a lot of noise. System will not be ready. Travel agents said, "Oh, our business will shut down." So to the travel agent, the government asked that this is COVID wave 2 is going on. What are you talking of? Our business will go down. There's no business. So what business will go down? It cannot go below what level you are at. And over time, people accept it. So that's how they kind of settled it. And banks were told that, look, take your time, but you start implementing. We know initially there will be teething troubles. We will not be harsh. Now coming to what that framework was, whenever a resident made a remittance outside India, and the amount of remittance made during the financial year exceeded rupees 7 lakh, then in addition to the amount collected and the bank's own charges, the bank had to collect tax at a specified rate. It was 0.5% if the remittance was for educational purposes, and the educational purpose funding was done either by a loan from a scheduled bank or from an approved institution. I mean, if it is boring, then I can change it. So let student know that I take out who is not paying attention. So, approved financial institutions as defined in section 80EE. When you go to section 80EE and look at the notifications, There are only two notified institutions. And one of them, as we speak today, does not exist because there is recently merged the bank. The only other institution that is notified is a purely student loan financing company called HDFC 3D Land. The other one was HDFC Limited. So these are the two institutions which are notified. I believe there are some applications in the pipeline now with the government where Section 80EE approval will be given, and you may in future have other lending institutions which, if they give a loan, then 0.5% TCS may be added. But otherwise, the rate of TCS was 5%. The other catch was that if a travel agent offered a foreign tour travel package, 4 words used, then without the threshold of 7 lakhs, TCS was to be done at the rate of 5%. So the question then raised, and which is now answered after 1.5 years in the circular issued on 30th, was what is meant by foreign tour travel package? If you book only a ticket, is it foreign tour travel package? If you book only a hotel, or if you just take forex from the travel agency, like Thomas Cook, for example, and you are aware of Thomas Cook, right? So Thomas Cook, I go to them and say I want FX. I can get FX from them, albeit at a more expensive rate than from a bank. But is that part of foreign tour travel package? And for a variety of reasons, and the banks were keen to have this because one of the provisions in section 2061, in fact 206 itself, says that if the travel agency has not done the TCS, then the bank is supposed to do the TCS. Now, in the circular that just about a week ago, a little over a week ago, they said that if you look at 3 elements of there are 3 elements: ticket, hotel stay and incentives, and other expenses. So, if 2 out of these 3 are booked with the same agency, then TCS is affected. And therefore, before you start your child accountant brain working on how to avoid this TCS, right? So, time and again, we have to tell people that, look, this TCS is not like GST, because sometimes the newspapers, some of the newspapers at least, give misleading headlines. Foreign travel becomes costlier. Foreign travel doesn't become costlier. It is not GST. It is only that you will get an adjustment of the tax collector at source against your other tax payable. If you are paying advance tax, then you can adjust that TCS against your advance tax installment and pay a lower amount of advance tax. That we all know, right? So, and why I'm again emphasizing this is because when the rate was proposed to be increased from 5 to 20, without exception, international media said travel from India becomes costly, and some of my college friends, school friends are overseas said, oh, but I want money sitting in my NRE account. Will I pay 20% tax on it? Interest actually. I said, no, my friend. You are a non-resident. This LRS doesn't apply to you. Don't have to worry about this 5%, 20%, 0.5%. So, now coming back, if there is a tax collection at source, obviously there has to be a reporting to the government, because the whole objective was that the government gets the information. So there is a quarterly reporting of tax collection force at source, Form 26CQ, which is there, and that, of course, you now see this year in the TIS or EIS. You also see it in the 26As. So that's all known. One piece of information is that this year, for April to June quarter, the deadline for filing a quarterly return has been extended to 30th. For what reasons, they have not stated, but the deadline is extended. But the deadline for depositing the TCS is not extended. There is also no extension for the quarterly return relating to the July-September quarter. April to June is extended. And you will wonder why, because any changes that have come, what will come to from 1st July this year, and we'll come to what are the changes from 1st July. And the rates now, as they are right, will change effective from 1st of October. So, looking forward to what happened on 1st February 23. On 1st of February 20, when the Union Finance Minister, she presented about 2061G. Number one, what was known to everybody the same day, or the moment she said it, 30 seconds were flashing on the TV, that the rate will increase from 5 to 20. Number one. Number two, no, 1st July. Number three, said that, no, these are two things she said. Then everybody started grumbling, those headlines we spoke about. Nothing really changed, but one small change which she did not mention in the budget speech, but which was there in the fine print, was that the words remittance outside India, which were there when the initial proposal was brought in 2021, those words, remittance outside India, were removed. And therefore, and not too many people noticed it. When the finance bill was looked at, that the words remitted outside India were removed. Which means, technically, because, let's say if you are paying to a friend, giving a gift and depositing the money into his NRE account in India, you can technically say there is no remittance. Or better still, if you deposit into his NRO account, there is no remittance. Question number one, therefore, is it LRS? And the answer given by the RBI, yes, it is LRS. You can give a gift to a relative as defined in the Companies Act, and that money can be given to the relative's NRO account, it can be given to his NRO account as well. So technically, although there is no movement of funds, it is subsumed as part of LRS, and therefore when all of us, we go to the bank to buy forex, if you are planning to travel, I have purchased so much forex from A2, and nobody bothers. I have not gone anywhere. This is the first time I am traveling this financial year. So FX LR is taken nil. Or passing an exam, that is still covered under LRS. But that has to be included. And this change is effective from 1st of July. The rate change is postponed, but this part is not postponed.
See, in NRE account, no, local credits are not allowed, domestic credits are not allowed. Right? So if I wanted to give a bond, my local check will be deposited in NRE account, right? So bank will not accept, right? So I have to follow the LRS process that.
One is LRS, or alternatively, you can give to the NRO account.
NRO account I can.
That is counted as part of LRS.
Still, it will be LRS. Yes.
Currency will not.
In NRO it will go. You can't put a rupee check into an NRE account.
So will it be counted as LRS?
Yes. RBI FAQ is there on this subject.
So the word remittance in LRS is a misnomer.
Yes. In the new scheme of things, because
New scheme of things.
Correct.
And it is a temporary achievement on the I take some money from a friend, first 10 days and turn it back 10 days. My remittance will be counted as a well.
First of all, the question is whether you can take that loan in the first place. You can, under MR, you can take a loan from a global bank, provided the interest free, and it's for short period pay only less than 1 month. It is a permitted transaction. But I think it will be counted with LRS because that $250,000 subsidies all remittances for an individual. I mean, I can still cross check, but my initial impression is that it is still covered with LRS.
Because this remittance is not counted as a
Because he's a non-resident.
and I'm returning that money, I'm actually.
So you cannot make a 15 CSCB because it is in one of the 33 purpose code. But my sense is still part of LRS. But we can examine.
Yeah, actually, Satnam, my wife is.
Sorry, I feel like this is a CA final exam.
Suppose I am
It is tougher than that because here actual transactions are involved. Huge transactions and huge TCS payments are involved.
Well, I am a resident, my wife is non-resident, and there are frequent transactions between us here. There's a spouse and student spouses. So all those will be covered under LRS.
Yes, you are allowed to remit up to $250,000 during a financial year for maintenance of those remittances. For that purpose code, you can use the LRS, which means your remittances to your spouse are covered. You do not need a Form 15 CSCD because it is one of the 33 purpose codes, so it is not required. But certainly part of LRS.
Even the NR form.
But earlier, it only involved remittance outside India. Now from 1st July, that outside India, that phrase is removed. Naresh, you want to supplement? Now, let's not go into.
First,
It's the right time of.
but be aware now.
7 days only.
And any experiences of the last 7 days you are aware of?
I'll come to those experiences.
Yes.
But one area where the limit of $250,000 can be exceeded, that has come to my knowledge, and this is not within the last 7 days, is where somebody is employed with a foreign company and that person has to remit money towards the exercise of ESOPs. Obviously, he has to pay for those shares in foreign currency. ESOP he has to exercise. Up to $250,000, it is part of ESOP. Well, supposing he has to remit more, that excess can still be remitted. Now, the tricky point is, if he remits during the first month or two of financial year, say $280,000, then technically after that, for any and every amount other than towards ESOP, he has to take a prior approval for remittance. So if he has to pay for child's education fee overseas, he has to take prior approval. Yeah, for 5 years. That is the way it looks technically. Now, what is happening on the ground to know? The other area was that when you look at the way remittances have been happening traditionally people walk to the branch, you fill the form 8, then TCS came in, still went to the branch. That was one. Second was that people sitting in India would make a payment online or a debit card or credit card. A debit card is always linked to an account. Credit card may not necessarily be linked to an account except for the purpose of standing instruction for repayment of the credit card. So you can have a credit card from bank, but not have an account with banking, and so on. The third, so the second channel is debit card, third channel credit card, and fourth the actual swipe of a card was again both debit card and credit card. And now some financial institutions have introduced the instead of a branch footfall, the facility that you can be sitting at home and do an electronic remittance of foreign exchange, but all the components of the Form A2, which would otherwise sign physically, are there on the portal. So it is a kind of electronic branch footfall. Interestingly, in 2021, when TCS or LRS first came, branch footfall was covered. Then debit card usage was covered. Swipe of debit cards was covered. But because of the FEMA capital account transactions, the usage of credit cards when traveling outside India was not covered. So everybody, including the RBI and the banks, merrily said credit card. Nobody looked at FEMA capital account transactions rule 5. Rule 5 was so in credit card usage outside India, no TCS. And people were happy. Credit cards swipe left, right, and center, not realizing that TCS at whatever rate can be set off against the tax. Whereas credit card FX transaction is normally subject to markup, ranges from 2.5% to 3.5% based on the bank. So it is more expensive, but people's mind doesn't feature in my 26As. Nobody knows how. Till sometime after the budget was presented, but before the final budget session day of the Parliament, the Income Tax Department found that some person had swiped on his credit card amount more than $2 million. $2 million, I'm not talking of $250,000, more than $2 million on his credit card issued in India for a destination wedding. Immediately there was an inquiry because the bank reported as a suspicious transaction. The inquiry was held and that those people were summoned. How can you use it? And they were very clear. Look at the definition of LRS, look at FEMA. Credit cards usage while outside India, it is not within the purview of LRS. So you cannot do anything to me. Bank cannot do anything because I have swiped the card, I have paid the money. So then, when this came to the notice of the ministry said, oh, this is a loophole. So then, in the speed of the FM, we amendments again. He said, credit cards are currently, so it is her statement, credit card payments are currently not covered as part of LRS. RBI will issue necessary amendments in regulations and notify a date from which credit card usage will be subject to, will be within LRS and will be subject to TCS. She said that and left it. Nothing happened. Banks inquired, everybody inquired, credit card holders inquired, when is it coming? Those who credit card holders realized. Then on 16th of May 2023, suddenly FEMA capital account transaction rules were amended by dropping a rule saying that earlier it was credit card usage when outside India is not part of LRS. That was dropped. And because it was notified, it became effective the same day. By the time people saw it, news, late evening, that day's transaction over, people at the bank level started analyzing. Again, took these things don't happen overnight in large organizations. Then everybody went to the government saying, said from 16 May this is good. So on 19 they said no, we will give relaxation. They issued a press release saying that up to 7 lakhs usage of credit cards, we will not have 2 TCs. And necessary amendments will be made in the Act and also in the FEMA regulations. The banks went and said, this is a press release, it doesn't work for us. And we cannot capture because you swipe a debit credit card at a terminal overseas. The information comes from third-party network. The bank is not sitting there. And in State Bank, HDFC Bank, Axis Bank, ICICI Bank is not sitting there. Bank of America maybe, but the acquiring bank there will be different from the Bank of America operating here, or acquiring entity may be different. So it doesn't work. It is not. The infrastructure will not be ready. It will take 6 to 8 months. Then we'll consult the RBI. Meetings are held with the RBI. Then somewhere in early June, scientific meetings all around. And then on 20th of June, another press release comes. Another press release comes saying that, number one, the 16th May, FEMA capital account transaction rules, that rule has dropped, that notification is again press release. Number two, that these rates of LRS will be applicable from 1st of October. Number three, that across all channels, 7 lakh rupee limit is available for LRS. So, except for travel agents, foreign tour travel package, it will not be able. And necessary amendments will be made in the statute in due course. 30th June, late evening, around 9:30, I got the circular from disability, more or less confirming what was said. What is not postponed is remittance outside India. That part is not postponed. Outside India is gone. Regulation amendment, that I have not yet seen the notification. Maybe I missed it. So if some of you have seen it, please send it to me. Number three, CBDT is issuing something saying that necessary amendment will be made later. Now, if I think of making it made later, the earliest that the amendment in Act can be made, but the Act says from 1st of October, 1st of July. The earliest can be made is either by way of an ordinance, or by moving amendment bill in one of the sessions of Parliament. The session will only be in December, or in next February, when there will be an interim budget. A full budget will be after the elections. So we don't know when those amendments will take place. And yes, yesterday that circular, there is a corrigenda issued on, but there will be some mistake of references which 30th. Therefore, today, if we go strictly on the basis of law, perhaps credit card usage outside India is technically still within the purview, but nobody in the sector is taking that technical. Everybody is taking that yes, credit card usage is not within the parameters of LRS. Number two, that the revised rates will be applicable from 1st of October. Number three, that the old rates will continue as they are, 0.5 and 5. But for travel agents, whatever we have said for free, is how they will look at what is meant by overseas travel package. Up from 0 to 7 lakhs, the rate of TCS will be 5%. And from 7 lakhs, or after 7 lakhs, it will be 20%. So far, so good. Now we come to having done the TCS. How does RBI get to know the information? There are ways a reporting system. Every bank at the end of the day is supposed to do a reporting to the RBI and XBRI based on the PAN. So therefore, if you want to use LRS, and that is also part of the RBI FAQs, if you want to have do a return to LRS, you must have a PAN. Now the question is, in the context of the 1st July transition, and PAN Aadhaar linkage, if it is not there, then your PAN is invalid. Of course, this is not the topic of our discussion. But if you have an unlinked PAN, that means PAN and Aadhaar are not linked, then can you still do the remittance under remittance? For that, one has to look at a 2017 circular of the CBDT, which gives exemption in 4 scenarios for PAN Aadhaar link. But it gives exemption only for persons who don't have an Aadhaar or an enrollment ID in your Aadhaar. Those 4 categories are one, number 2, persons who are above 8 years of age. Number 3 is persons resident in the state of Meghalaya, Assam, and Jammu and Kashmir. And there is one more. So the condition is that the person should not have a PAN, should not have an Aadhaar. So strictly, if you have an Aadhaar, then linking is required. When you go to the income tax portal, I actually had somebody who was above 80 years old who has an Aadhaar. And just see what happens in the portal. You are not required to link your Aadhaar and PAN. Just take a screenshot and keep it. But the law doesn't say that. The portal says it. I said one may be a system failure or exception. So I had 3 people above the age of 80, all 3 having Aadhaar, but not having link with PAN. I had all 3 of them do it. I said, second one, same message, take a screen. Third one, take a. So technically, the portal does not require the linking, and therefore I assume that for such people, even if the PAN Aadhaar linkage is not done, you will have the ability to the LRS. Next point which comes. Next point that comes up is that, as we said earlier, the RBI FAQ allows LRS usage irrespective of age, whether it is minor or major. And you will come across, those who are anchors here, you will come across several situations. And those who are chartered accountants will try and do the LRS verification. There are 4 people in the family and they have the money to afford. $250 is roughly about 2 crores of rupees. It is over that, but it's around here too. Those who are able to afford it, do a remittance from each of the family members. Maybe mine. Now, if there is a TDS in respect of minor's income, there is a process to transfer the TDS credit one day by 137BA, or alternatively, where the income is clubbed in the income tax return and on the portal, the utility allows you to say TDS in respect of person whose income is clubbed in your income. Now, those of you who actually do return filing, and I don't, you will see. I mean, even my own return is not filed.
You do file, no?
Huh?
You do file, no?
I don't file any returns. Even my return is handled by some other chartered accountant. So those,
You verify it.
I only apply my digital signature.
Verification.
You only share with
Verification.
No, I'm that bad, but I will not say. So
Sometimes lighter moments are good in a heavy topic.
yes, this is heavy. I thought this is just routine discussion. But
Big transaction, TCS amounts are very high.
yes,
And it's interesting, but it's really very heavy.
it's heavy, so you have a cup of tea.
Then the host,
Naresh is saying.
that host will do it.
So
And
coming
you
back,
put some
therefore,
time.
now if you look at the income tax return form, forget the utility, return form. You look at the income tax utility, it has no feature to say TCN deducted in respect of a minor be credited to them by the parent. There is no such column at all. And this has been brought to the attention of the government just in May, not June, early June in the meetings, and they were also surprised. So we will have to check with the systems guys and we'll get it organized. So those of you whose clients claim that my son's remittance is done under LRS and that son is minor, I can claim credit. You may have to tell them, look, you can claim the credit, but there is no collar in the return or in the portal to claim that credit.
Suppose I get my PAN card from a minor child.
Yes.
Then under that situation, I am not filing return for it.
Mr. ID, so you do your own LRS under your PAN. Your spouse under her PAN. Your minor child, son or daughter as the case may be, in their PAN. So that is allowed as per RBI. We put it to the RBI portal. Banks, at least some of the more diligent banks, the TCS has to be the same name as the PAN reported to the RBI. Because there has to be consistency to regulatory reports. One to the income department, the other to the RBI. If there is inconsistency, the bank will be queried. What is this inconsistency? So that is a gap that is there. I don't know which version of the utility. So this is the part of the presentation that I thought I would share. I have briefly touched upon linking of PAN and Aadhaar. I am not going into other issues, and certainly I don't think we have time to discuss Gift City, despite that.
No, we'll discuss it. We'll discuss it. The 10 minutes will do. But topic is important. We have to discuss.
The mechanics of TCS is when you use a credit card. In a normal bill, credit card, what is the mechanics in mind that how do you bank
So, you are taking me to a 5-hour discussion that was held in North Block with their officials to explain how it happens. I'll try to take it in 5 minutes. So, when you swipe a card, whether in India or outside India, there is a small machine which is there. Or now we have those UPI. That small machine generates a message which is transmitted through the settlement platform. It could be the RuPay platform, which is NPCI, or it could be the what we call open usage platforms. There are closed usage platforms like Diners Card. That's why you might find that Diners Card is not necessarily accepted by all outlets. There's a Discover platform also, which is very small. I mean, I'm sure you are aware of this. Not everybody will be aware of this. But that message is transmitted to the bank. These are the settlement agents. And on a daily basis, a report on all card usage comes to the bank itself through the settlement. The bank checks it at its own end. Obviously, volume of transactions is very, very large to be done electronically. And the settlement platform determines how much money is payable by one bank to the other. So in order to apply CFOs, number one, if you swipe a credit card in, let's say, Starbucks in New York, it's part of your expenditure as part of your travel. If you go to John Hopkins is a hospital, it's a teaching institution, it's a research center, there's a cafeteria. All people are there. How does one determine at the India end? Because John Hopkins has not signed up with any of the Indian banks, but I will take your POS machine. Their POS machines are the US-based banks. So there will be a merchant category code which these Visa Masters platform generate, which will have to be scanned by the bank in India to determine which category falls. Now John Hopkins have eaten sandwich, and therefore a person who is I don't know as a banker. Your research scholar and part of education, I don't know. And you can technically say that if you are a research scholar and you spend at the library some $1 for accessing a bank. Then a scheduled bank has given you a loan, therefore the rate cannot be 5%, it has to be 0.5%, because a credit card swipe results in a loan from the bank to you. Although no interest is charged, and Rohit is an expert on credit cards payments, so it's technically a loan. In the bank's balance sheet, credit card outstandings will appear as unsecured loan. The RBI norm on NPA classification apply to credit card outstandings as they apply in respect to unsecured loans. Therefore, it's 0.5%. This was actual discussions held in the ministry. In this, yes, we'll have to see. And the banks, because they are still developing the system, these rates will come in. But there is a breather, therefore. So it's not an easy task.
So once you know, get at that.
Now the question. Now you have the more important question, right? And which I'm sure Bancam, although it has only corporate credit cards, they don't have retail credit cards. You don't have retail presence in India.
We have some corporate cards.
Corporate cards. But there are others. I think ICICI Bank has, so not in your area of work, but HDFC Bank has, others have. He's an expert on the HDFC Bank credit cards.
Not an expert, but
So this is supposed to be a tax collection at source. Does their billing to the cardholder result in a tax collection?
The seller has to bill it. The one who is acquiring the transaction. Sitting overseas.
But he is not required.
And then he is not under the ambit of law.
But then we will not agree to this solution.
Just extrapolating the actual law.
When you swipe say $10 for a sandwich and a salad at John Hopkins, $10 translates into the bank system here. Let's say 85 rupees, 850, and you already crossed the 7 lakh limit. So simplify things. 20% has to be added. Foreign travel, 20% has to be added. So 850 plus the bank's own charges, whatever they are, plus GST on the conversion, plus 20%. So your $10 sandwich becomes at least $12, not more. On $10. So $2 more. $2. It's not grocery. $2. It will not. It is not the other way where you are bearing part of TDS cost. So $2. You swiped your card on, let us say, 8th of July. As per billing cycle, your bill will go out on, say, 25th of July. Your payment timeline is 13th of August. Is it tax collected until you get a bill? That is a question that has been posed. And what has been suggested is that till the card holder pays the bill, kindly don't treat it as tax collection at source. And this question does not arise for debit cards, because debit card is linked to an account. Any other questions? I think Manoj is saying either T or you stop. So
no, there are lots of questions and issues, but let Sunil start his presentation, and we can take more questions collectively. But cover slide should put it first. Is there? Just put it up.
Sorry.
While we are doing,
he is
just put
asking something.
You can switch. Just put a cover slide on.
The question arises that what if a person does not make a full payment of the card and he made that minimum payment?
So there is a solution that has been suggested to the government that under consideration, and at this juncture I am not in a position to reveal what the discussion has been. Okay. So thank you. My time is up. The chairman has suggested.
It's a continuity. So there is an open house. There is an open house, so it's a continuity. That's the best part of this roundtable.
Chairman also promised specificities.
Yeah.
You should get something more with that possible.
No, we don't need a break. We'll
No,
start.
because there is a lot of content, and yes.
This is a more interesting concept.
Manoj sir, actually what Sunil, what you told, we don't have, although you are saying so many people interested, But now I can proudly say कि अभी quorum हो गया है. Full, it's more than full.
So the point is,
Because
you
I
know,
think people.
it was so specialized, and there was a feeling it will be short. And so deep dive, we always, the roundtable is known for deep dive. We could do a very good dive, and hopefully a justification has been done. And incidentally, last 7 days, just came to know there are no irate customers at the wealth management and HNI desk of some of the premier banks at least. That's what we came to know. Huh? So the market has accepted it. The customers have accepted it. Huh? And yes, but what comes out from here, ease of transaction is getting affected. Ease of transaction is getting affected, and unnecessarily burdens and compliances are being forced upon the system.
Right.
When we are moving ahead worldwide, globally, in payments, so ease of transaction is affected. So hopefully the regime should be more friendly, and how friendly is, we will also see the latest what's happening, a kind of a deep dive comparison on investing. Investing drives the world economy, and whether you do it directly, $1 million or $10 million as a HNI, or as an individual and plan your taxes, or do it through PMS or MFs or AIFs. AIFs is a come. AIFs is a new mantra now. Yeah, welcome. AIFs is a new mantra. Everybody is raising AIFs. We know AIF is there raising 10,000 crores by a former fund manager. And in fact, when we are talking about AIFs and mutual funds and PMS, here arrives our chairman of the Capital Markets Committee of WRC. So very deep dive discussions are going on financial markets globally. Latest developments, what happened on 3rd of July, what happened in Gift City also, what are the expectations of our Prime Minister. We also shared this book which has come about on this. So deep dive each and every aspect of transaction, whether it is individual, HNI, PMS, mutual fund, AIFs, that's a mantra, and post-tax, pre-tax, LRS, frauds, latest on NFRA on frauds, latest from SEBI on frauds, changing role of CFO from the angle of regulators. It all happened in the last 1 month, and we have several heads of treasuries and CFOs here. We have a top person from WOCAD. He's sitting behind because there is limited space. Come forward, huh? And incidentally, yes, and lots of so great. And Madam, can I request you to just share a few thoughts? And I'm glad you really took our time and came at the right time. And we have a packed conference hall.
But I don't want it to disturb and interrupt in between.
It's a continuous flow. You came at the right time when we are discussing AIF and the latest funds raising of AIFs, right? We were just discussing about it.
So I have very little knowledge in this subject. I cannot say that I can share the views, but would like to hear from all of you. So no views on this because this is not my cup of tea. I am an audit person, and if you request me to speak on that, I don't know what I am going to speak on that. So I'm so
fine. And I would just share Swetaji or Sweta, she has enabled us. She said you can do a program on sustainability, full day conference, half day conference, anytime she will do it. And incidentally, we have quite a few speakers on sustainability here, huh? And with the global knowledge and capital markets, workshops, seminars, full day in the auditorium. She has said go ahead and do anytime. So Yogesh is here. He has lots of plans, huh? Along with the team. So that will take place, and it's glad you are here. And with you here, they'll be encouraged to come out with a pipeline.
It's really my pleasure to interact with all of you and to be here with all of you today. So, जो सर बता रहे हैं कि Sustainability Committee and Capital Market Committee, these two committees I am chairing this year at WIRC. So, in be it capital market, sustainability, or digital accounting assurance board and ethical standard also, these four committees I am chairing. So, if you want to conduct any program, maybe short webinar, 3 hours or 4 hours physical webinar, any, So yeah, this group is very active since last year, so I am witnessing that कि काफी अच्छा discussion हो रहा है. A lot of knowledgeable people are here, elite people are here in this group. So I can request that if you all can volunteer yourself and can speak. So just give me a subject, so I'll finalize the date and topic, and accordingly we can plan a session.
Because you just want for 2 minutes, can you just say what is there in sustainability? So what we are.
Yeah, so sustainability, I'm sure you all are aware कि अभी recently it's a talk of the town. Everybody is talking to ESG, BFSI, listed company को तो applicable उन्होंने कर ही दिया है. There in more of the world is shifting towards the 3P that will completely change. Now, profit, people, then it's a planet, people, and then profit. So the complete paradigm has been changed now. So our institute has taken the responsibility to develop a social standard also, and 16 standards has been developed. And now also अभी तो उसमें social audit से related exams भी हो गए. You can clear the exams to NISM and you can become eligible for social audit. So one responsibility under this committee. The second is अगर आपको कोई भी suggestions है, if you want to put it to the central level, तो वो हम कर सकते हैं. करिकुलम में कुछ चेंजेस लाना है वो कर सकते हैं, because ESG business responsibility and reporting, this is also part of this committee, and social audit. So these 3 things are covering in this committee, and we are trying to gather as much as information.
Last year, we have received the proposal. Everything was clear. Last moment, because there was a concern regarding the pollution. There is one copper and aluminum company in India having a problem in South India, Tamil Nadu plant. And there was a Supreme Court litigation going on, so we have to reject their proposal. Most of the people know the name, I don't know the name of the name. It was a very lucrative proposal, no problem as far as financial is concerned. But just because of ESG, I just people have run down the profit on your cost.
Because now to expand.
Vedanta Supreme Court, still the judgment has not come regarding that Tamil Nadu plant. So we have rejected it.
Because अभी तो they are expecting even from the chartered accountant कि आप सिर्फ financials मत देखो ये भी देखो. But if you ask me for, I have my own doubt that how the company are going to measure this, because parameter is बहुत vary करते हैं. For you it can be a different, for me it can be a different parameters to evaluate.
Regarding environment, we are not the expert, but we can rely on the Supreme Court judgment, we can rely on the environmental engineer audit or pollution control board if there is a litigation.
Yeah.
So such thing we rely. It's a technical matter. Or
yeah.
Global standards, I mean, Europe has got high focus towards like Paris Agreement.
Right.
The earlier they were like since 1979 they are doing this. So by 2030 there will be a lot of expectations from India, and like when we talk about international drops by the bank or every bank there, we have easy task force report which is mandatory for everyone, and there are a lot of platform wherein you can evaluate the scope 1, scope 2, and scope 3, how these calculations are done. So if you want, we can like work together.
And I would like to acknowledge Mr. Prakash. He is corporate banking with South Korean Bank, and Aditya at the global top management team of a top 20 in market cap at global level, and he has done a certification on sustainability at global level now.
Yeah. That's great.
In fact, on that she mentioned you do a program anytime. I said we will tie up together. And
I think इसी तरह के brainstorming sessions रखेंगे तो it will be helpful.
Usually, yes.
Otherwise तो ठीक है.
Here I also want to add that since this topic is now these regulations and voluntarily the government is also come with the guidelines. So many of the banks, like I'm from one of the banks.
Yeah, I would welcome you. Just mention your name and designation and welcome.
My name is Ramesh Gowde. I am from Indian Bank and I am a chartered accountant by profession. So lately, what is how the ground level is working. So I can add one. So the thing is that I don't know to name the name, but in our board approved policy, credit board approved policy, what we are doing is that industry-wise classification we have done, like apna high risk, low risk, medium risk, like that. We have tabulated an industry like shipping, oil. These are the where the high this one is being created exposure, like exposure. तो उनको हमने social responsibility में high risk में डाला है. So like that industry classification, that is our own judgment. This is our initial level. So वो हिसाब से now we are starting working on that. So accordingly, whenever the any credit proposal has been passed, so by default the financial risk will be there, but with that this risk will also getting categorized by default. So we are monitoring that industry at ground. This one as a practical level. And now
banks are short giving loan for the push.
But I'll tell you, Prakash, that has again restarted it. It's known to be a international scam just to favor some countries.
I can add the one more example also in this. This is practically ground level. This one we are working. So we have almost 2,000 branches managed India. So recently we have done the study on our ACs. So we found that almost all ACs are 3-star. So we are started converting into 5-star because of carbon emission. So that is also one cost. When we have find out these the things is that, so in order to replace that third AC, 3-tier AC with the 5, cost is around 150 crore.
And what do you do with this AC?
So all these are challenges are coming. This is a ground level example. So this thing is coming up. Now the board has to take the decision on this also, because one side is the money, one side is the guideline, one side is really we want to do something for our country. So these things are coming. These are the challenging things are coming. So that is ground level example.
Like in the book, I read one line which was very
430 will end.
They say some of the countries are only coming up in the newspaper that they want to do something, and they highlighted India and mentioned that Narendra Modi mentioned that they want to do something on nationally determined contribution. However, they are just coming up with a newspaper commitment. So maybe at CNC level, we can have some guidance where we can support this commitment what we have that by 2070 we should be net zero. That would be really great. We can support projecting our country as a better country as compared to the world, wherein the world is pointing towards 2050. Bill Gates has written a book wherein he mentioned that 51 million to zero. And that is the target by 2050. And India is much behind.
So Shwetaji, I'll just summarize saying things are, as you said, for financial also, for chartered accountant also, next wait for a decade, if not more, things will change. So these financial risks has to be actually merged with the ESG related, because these parameters will at least start percolating from maybe financial institutions like banks and others, where they'll change their board policy, risk policy. So slowly it will get down to no, but it will start and slowly things start gradually, and it has to pick up the pace, because the way sustainability world sustainability तो how will company
There's obviously a lot of noise and talk.
So it's a good topic you are actually looking at, so you should start actually emanating this very
One webinar we've realized on role of chartered accountant.
Because currently you will see there is no role. Technically there is no role.
Actually, there is a role. Many professionals are playing a very, very intricate, deep role in sustainability. And it is not only sustainability as a buzzword globally. Sustainable living. India has always had the advantage. Sustainable living came from India over 10,000 years ago. Sustainable living. That is sustainability. Yes.
Sir, हमारा योगा ही वर्ल्ड को सिखा रहा है.
Exactly. Yoga सिखाता है, Veda सिखाता है. World is one family. It is all based on sustainable living, and it's fortunate actually sustainability became a buzzword, and it's to our advantage. Now what's happening at ground level, also how big money is flowing, we will take it. Sunil? And Shwetaji would like you to hear and see be part of the discussions on how money is flowing worldwide and supporting the India growth story. Sunil.
So good afternoon. So after Sunil's presentation on a short topic, LRS, now another Sunil continues on a big topic called taxation of stock market investments and trading in different financial instruments. So the purpose of this topic is that since all of us as chartered accountants invest, Mike?
No, he wants you to be more louder.
So as chartered accountants, we either invest for our own self or for our clients or for our organization. So the purpose is to make you aware of generally what are the some of the basic things we would always be aware, because we do invest, we pay taxes, we file returns. But I want to draw your attention to some of the finer nuances which nobody generally tells you. Wealth advisor don't tell you, the brokers don't tell you, and even the fund houses don't tell you about those. So I would suggest that you, on the first few slides is about the basic, the tax rates and etc. But try to focus and appreciate the points which are there in the later part of the presentation. So these are the contents broadly that we will talk about. What are the different categories of income when you invest in India? Since there is a lot of content on the slide, you can see the slides on opposite you. We will look at the tax rates and what are the rules for short-term, long-term. We look at investment directly in the stock market and through various funds and advisors, and a brief overview of AIF taxation, because then we can compare AIF with PMS, with mutual fund and so on. And briefly we'll talk about, as an investor, how much help or how much data you can get from AIS, TIS, and how useful the pre-filled ITR forms are, and which are some of the software which are available in the market, the third-party software which might help you in consolidating the profits that you generate from the stock market trading. So to begin with, let us look at some of the different instruments and how they are taxed. So typically you will come across that the securities that you have available in the stock markets are either listed equity, debt, or mutual funds, or you have all these instruments which are listed, which is either listed share, and depending on how you trade, whether you take delivery or you don't take delivery, or whether you trade in futures and options. So here basically this slide discusses how the income of these from these instruments is taxed. Now typically broadly what we need to be clear about is whether the profit will be taxed as capital gain or as business profit or other income, because globally income from capital gain is taxed at a lower rate. So similarly, India follows the same principle that capital gains are taxed at a lower rate compared to the normal income. Therefore, characterization of income is very important. Similarly, the rules of set-off of losses is also depends on whether the loss is from capital gain or business profit, and similarly, how long you can carry forward. So that depends on whether the income is capital gain or not. So in case of listed shares, the first category, the CBDT has clarified that if the assets are held for more than 12 months, then the income will be mandatorily characterized as capital gain. Otherwise, you can go as business income characterization. Now, normally, it's not very clear as to what should be capital gain and what should be business profit, because it all depends on the person who's buying and selling, the circumstances, and the various other factors which are laid down by courts from time to time. So there is no specific black and white law as to when income is capital gain or when is business profit. So it depends on a large number of circumstances. But in case of listed share and debt, CBDT has clarified that if you hold the stock for security for 12 months, then it will be treated as capital gain if the taxpayer wants so. Similarly, in case of listed shares but intraday trading, which means that you take delivery, then such profits are treated as speculative profits or speculative losses. In case of unlisted shares, irrespective of period of holding, the profits are treated as capital gains.
Say 12 months and more than 12 months, then it is long term.
So in case of unlisted stocks, irrespective of period of holding, even if you hold for a month, the profit is treated as capital gain.
No, but is it short-term capital gain or long-term capital?
No, that depends on the period of holding, which I'll come to. I think.
Okay, therein it's not clear cut 12 months and that.
No, it's clear cut. It's 3 years.
So whether it's long term or short term, I will come to in the subsequent slide.
Okay, for unlisted here.
But just now we are talking about whether the profit is capital gain or business profits.
Yeah.
Right. So in case of unlisted shares, for now just hold this thought that irrespective of period of holding, the profit will be treated as capital gain. The next category is futures and options. Futures and option contracts are generally available for a short-term contract, either a 1 month, 2 months, or 3 months. I don't know whether 1 year contracts are trading or not, but generally it is 1 to 3 months. So because of the period,
1 month contract. Normally that's where the major transaction happens.
Yeah, but 1 year is not available at the moment. Yeah. So therefore there are 1 or 2 or 3 month contracts. So therefore then by essentially the character is that they are of short-term nature. So therefore they are treated as short-term in that sense, but because they are short-term and because you don't hold them for a long term and it's a repetitive activity typically, generally the investors would characterize this as business profits.
Is it capital account?
Yeah, you can. I mean, there's no bar. No, I don't know.
It has allowed.
You can and you do also, and there are many who do. And now, since the last few years, it has been specifically allowed.
Yeah, because as an investment, definitely we can do that. Trading, maybe future option derivatives, they're allowed now, so that's not a problem, right?
Right. And earlier we used to say it is for hedging against investments.
Okay. Similarly, unlisted debt securities, generally the profit is treated as capital gain. And finally, the capital gain from the profit from debt mutual funds and other mutual funds like ETFs, etc., they are treated as capital gain irrespective of period of holding. And the last category is debt funds, which are more than.
Listed debt mutual fund is treated as capital gain. More than.
Yeah.
First line. Listed equity. Debt also.
No, so this is first category covers listed equity, debt, and equity mutual funds. Equity mutual funds, not listed mutual funds. So listed mutual funds, which are typically the ETFs, which are traded on the stock market, that get covered in the second last category. And the last category is debt funds, 35% equity. The new category used in this current year the law. Generally, these are taxed as capital. So if you keep this character in mind, then the subsequent other things naturally automatically flow. And the last part of the slide covers about the rules of set-off. So generally, the short-term loss can be set off against both short-term loss and long-term loss, long-term gain. And long-term loss can be set off only against long-term gain. And the losses are carried forward for 8 years. Speculative losses are carried forward for 4 years. And the business loss is carried forward for 8 years. So if it is futures and options, generally the loss will be treated as business loss and it will be carried forward for 8 years.
Business loss cannot be set up against salary income.
Yeah, in the same year you can. In the same year you can. In the same year you
can. In case of listed NCDs, non-corporate ventures, so there is a monthly interest which is there. So in that case, it will be under the income from other sources as interest income or short-term capital gain.
So if you receive interest as interest on the coupon rate, then that is taxed as interest as a source. But buying and selling any security come interest or selling on the whole consideration is treated as a part of purchase price or sale price.
Okay, understood.
So for these instruments now coming to the period of holding, that decides whether it's long-term or short-term gain. So wherever the profit is treated as capital gain, then you look at the period of holding, and as you can see for different categories, there are different periods of holding to treat it as short-term and long-term. Broadly, without going into too much of detail of each of these, broadly in case of listed share, it's 12 months. Futures and options, it cannot be 12 months, it's always short-term in nature. And in case of unlisted shares, 24 months. And for debt and debt funds, it's 36 months. So these are the broad three buckets, if you remember. Listed shares is 12 months, unlisted is 24 months, and the debt is 36 months. So this determines whether the profit you earn is long-term or short-term, because long-term or short-term will also decide the rate of tax. So for long-term, now normally the tax rate for listed is 10%, short-term is 15%, and unlisted is 10 or 20% depending on the whether you want to go for with indexation or without indexation. And I think most of you are aware that indexation means you adjust the cost for inflation. So the law gives you an option to either go for 20% or 10% without indexation.
Yeah, there is an anomaly between unlisted and listed. As we've been talking that they will make it uniform, but they are not doing it.
As of now, there are a lot of categories and
In ETF, gold ETF,
yeah.
it is the same requirements or 36?
30, the ETF is treated, any fund which is treated as a non-equity fund is 36. Yeah. So the next part of the presentation is about comparing transactions of
इसको एक एक कर दो.
So moving to the next part of the presentation, with comparing direct investment compared to investing through mutual fund, PMS or AIF. So before that, therefore, I would like to do first a comparison of AIF and PMS.
Yeah, please continue.
Now, I think most of you may be dealing with clients who are HNIs or your colleagues who are HNIs or would want to advise HNIs. Therefore, for you, it's important to understand that for HNI, there are two very popular modes of investment. One is PMS and second is AIF. Because for PMS, the minimum amount of investment required is 50 lakhs, whereas for AIF is 1 crore. So I'm beginning with a comparison of investment between AIF and PMS. First two slides are mainly on the mechanics and the procedure and the regulatory aspects, and then we'll get into tax. Yeah. And then we compare AIF, PMS with mutual funds.
So I was requesting our speaker, while we are munching something, we can also have one bite in between. And
No, unless you want to take a 2-minute break, then I'm okay. I'm okay. I don't need this for extra energy. No, I'll wrap up and then don't worry. I'm okay. I'm perfect.
You can take cumulative break. Yeah. For the benefit of the speaker. Yeah.
No. I mean, if y'all are okay while listening while eating, I'm okay talking. I have no problems. So see now, in case of AIF, it's a fund. Okay, so the investment decisions are taken by the fund manager. PMS, you have the PMS manager gives you an option that do you want a PMS scheme which is discretionary or non-discretionary. In discretionary, the manager has a discretion. He simply buys and sells stocks without consulting you. In case of non-discretionary, he asks the clients, he confirms with the client, and then accordingly buys and sells the stocks. Then in funds, in case of AIF, the money goes to the fund, whereas in case of PMS, the PMS manager, portfolio manager, is expected to keep a record of each person's investment, because somebody invests 50 lakhs, another person invests 75 lakhs, and so on. He's supposed to keep a separate record, not necessarily a bank account. But in case of fund, AIF is like any other fund, so the money gets pooled. So therefore, there is pooling of funds in AIF, but not in PMS. Similarly, in case of, I will skip some of these aspects which are relevant from the manager's point of view, because we advise a lot of capital market fund managers. So things like how much capital required, what is the tenure and lock-in and so on. And in coming to exit charges, generally exit charges in case of AIFs are driven entirely contractually. There is nothing in the regulations. So therefore, whatever is mentioned in the contract or the PPM, the offer document, and the contribution agreement which is signed by the investor with the fund, mentions what are the exit charges. In case of PMS, generally similar to mutual fund, pay charges of 3%, 2%, 1%, depending on the year in which you exit. And minimum net worth requirement is the 5 crores in case of PMS for the PMS manager. And the minimum investment for AIF is 1 crore and PMS 3 lakhs. And the minimum corpus that AIF must have is 20 crores before they can start investing. Whereas for PMS, there is no such minimum corpus requirement. That means the moment they have a PMS license, even if they have one client with 50 lakhs, they can start the business and continuing interest of the manager has to have his skin in the game in the form of his own investment. That is required for all the categories. There are 3 categories of AIF. Cat 1 and 2, 5 crores, and Cat 3 is 10 crores. For PMS managers, they don't need to have their own investment because there's no separate. You give them your money and they are investing that money, so they don't have to add their own contribution. And the leveraging, which means borrowing, is not allowed by the funds and the PMS. So that's a similarity. So coming to now the taxation of AIF and PMS. In case of AIF category 1 are treated as pass-through. Therefore, the funds are not taxed. The investors are taxed directly. The moment a fund earns income, investors are taxed in the same year, irrespective of the fact that the fund has declared or distributed any money to the investor or not. And the fund deducts tax at the rate of 10%, and that is credited for whatever is the final tax. In case of AIF, the fund pays the taxes. So normally AIF3 are the ones who invest in listed shares. 1 and 2 are meant for unlisted shares. So now coming to comparison between the tax rates for investing directly as compared to investing through AIF and PMS, this is how the things look like. That broadly you will see that there are very minor differences in the tax rate which investor ultimately bears. But there are minor differences in terms of timing of taxation and the surcharge that one ends up paying indirectly. So broadly, the tax rate one pays for long-term listed shares is 10%, short-term is 15%, and for the rest of the short-term profits from F&O, debt, and interest and dividends, all 30%. So there is no difference in the rates of taxes. But what you're going to notice now in the subsequent slide, and that's what helps people decide whether you should invest directly or through a fund. So first of all, one problem with investment through AIF and PMS is that there is a taxability in the hands of the investor even when there's no real income earned in the first few years. So let's say today you invest 50 lakh in PMS or 1 crore in AIF. The PMS or the AIF starts earning some profit, but there are major management expenses. So in the first year, they may park some bank account from which they may earn, but there are management fees that you pay because management fee of 1 or 2% begins right from day one. So in the first year, let us assume that there is an income of 1 lakh or 2 lakh. Management fee with your shares can be more than 2 lakhs. So in real sense, you have not made any profit. That profit is taxable in your hands. That's a big issue in case of first initial years. When you're in the first few years, the investor ends up paying taxes. In commercial terms, there is no real profit because your real profit is negative because you are also bearing the management expenses. So if you ask for a NAV statement, net asset value statement, or your record of your worth of your investment, it may show negative. First year there's actually a yet for tax purpose you are paying taxes, the gross income. Similarly, the allowability of management for investors. Under tax law, there are specific rules for various categories of income. If you are engaged in business, then the law says that whatever expense you are incurring to run that business, you get a deduction. In case of capital gain, there is a specific rule which says that you, from the sale proceeds of any asset, house, share or whatever, you can only deduct cost of acquisition and costs incurred in connection with transfer of that asset. That means any expenditure which somebody can say is not in connection with cost of acquisition or cost of transfer is not allowed as deduction. So therefore, if you are paying a advisory fee to an advisor or a PMS manager, there is no clarity whether such expenditure is allowable or not. So if a PMS guy buys Reliance shares for you at X price, sells for X price, and you make profit, you can at the most deduct brokerage, because brokerage is directly with buying a stock, selling a stock, or cost in connection with transfer. But advisory fee is not covered. So therefore, there is a dispute and there are conflicting rulings, and therefore taxpayers take their own call when you file your own return. So that's a big disadvantage of investing in AIF and PMS. Thirdly, the AIF3 category investor, which invests mainly in the listed shares, cannot set off losses in the first year, because in case of Cat 3 AIF, the profits are taxed at the fund level, not at the level of investors. Therefore, that's a big disadvantage for Cat 3 AIF. Of late, you would have seen last 2 or 3 years, several AIF managers have Cat 3 AIF, which is in listed stock. So conceptually, it's very similar to a mutual fund, but AIF taxation is very different. AIF taxation happens for AIF3, the tax happens at the fund level, unlike a mutual fund where the mutual fund is exempt and the fund pays tax only when you redeem. So this is another big disadvantage for investing in listed shares through AIF. Thirdly, AIF charge at the highest rate of 15% as compared to 10% on capital gain and dividend. So till 2019, there was a cap of 10%. In case of AIF, if AIF pays taxes on your share of income, exactly in the manner you would have paid had you invested directly. But typically, what happens is that AIF managers do not know what is your level of surcharge. Now, surcharge is the level of income, whether you income 50 lakhs, 50 lakhs, or 50 to 1 crore, 1 crore to 5 crores, and so on. So, what industry practices that they, as a matter of administrative convenience, they have been paying taxes on your behalf, on behalf of investors, at the highest surcharge. So, that is another big disadvantage. So you have no means to adjust, because you are whatever share of income you receive from Cat 3 is completely exempt in your hands. Therefore, you are not even supposed to disclose that or add it to your taxable income. Completely disclosed as exempt income. And last disadvantage is that in case of AIF Cat 1 and 2, in case of death, the legal heirs can carry forward a loss only after holding it for 12 months. That the inherited investment. So this restriction is not there for mutual funds. Therefore, again, AIFs suffer from this disadvantage compared to investing either directly or through a mutual fund.
When I have an income, I have a loss carry forward.
Yeah, so the fund carries forward loss. In case of Cat 3, the fund will carry forward and set it off against your share of future years. In the same year, you cannot take it forward and adjust your income.
In my life.
Yeah. In case of Cat, since they are past, the loss can be carried forward by the investors. Cat 1 and 2, which invest in unlisted, which is basically the private equity fund, there you can carry forward and the investor can set off the loss, but not in case of Cat 3. Yeah.
In Cat 1, in Cat 3, I cannot take that.
Yeah.
So it is carried forward under AIF.
Yeah. Cat 3.
Management fee for PMs or AIF, whether it's can't take it as
I mean, there are conflicting rulings. So there's a pool favorable, but I've been advising that in my personal view, they should be deductible. because management fee
Directly linked to the PM.
activity is not a charity, it's not a donation that you're giving to somebody. It is in connection with buying and selling of stocks.
Consulting charges or something.
So I have been advising my clients to claim it as a deduction. Personally, I've been claiming, but there is no clarity in the law. That's what I'm.
Getting allowed also.
Yeah, it's getting allowed. See, getting allowed does not necessarily mean that the tax department is accepting it, because it's possible that they are not noticing it.
Yeah, right.
So what happens is typically in the PMS,
Reduced from the capital gains, or it has been reduced from the.
so as I said, your income will typically from when you invest in shares or debt, you will be either from a capital gain or dividend or interest, or business income if it is F&O. For business income and other sources, the section or the rules are relatively more relaxed and so you can say open-ended, because they say that any expenditure incurred to earn that income is deductible. Whereas in case of capital gain, it says that acquisition or cost connection with the asset. So therefore, suppose you sell a house, brokerage is deductible. But suppose you are going about consulting somebody where to buy, he tells you that he shows you 10 properties and he charges you for that, and you end up buying 11 properties. Then what do you do with that asset? So therefore, same applies to stocks. Advisory fee is doubtful, but then take a judgment call.
Dividend and interest income.
Yeah.
Part of AY for PMS, I can take it as a deduction.
Right. So for dividend, they have now changed the law to say that from dividend you can claim only interest if you have borrowed capital. So you can't claim any other interest. But from interest you can. So what I have been suggesting to all the clients, suppose you have invested 50 lakhs in PM, you have capital dividend, then try and claim maximum expenditure possible against interest income. Because even if it results in a loss, then you can set it off as other income.
And dividend incidentally is coming fully in the pre-filled form. Interest only parts are coming. Bank interest,
Yeah.
Other interest is not coming.
Yeah.
But as per the principles of tax, expenditure incurred to earn the income, it is claimable. That's why you are claiming. So it's not that chalta hai. So it is based on principles of tax.
Why I said so? Because there are disputes upon that, right?
The point is on scrutiny, there may be different views based on the person.
So long as getting allowed, because it's logical to adjust it
Yes,
again, right?
logical, yes.
But the law may not permit that, right? So that's why I say.
The law permits it. Law doesn't prohibit. So what is not
There are disputes
prohibited?
on that. There are some criminally said. There are some it's not allowed, some
But you mentioned positive cases.
There are positive also. So depending on which you are in your circumstances, you by various factors, how big the amount is and what is your other income, what are you setting it off against.
Now, capital gains may not be there. Then in that case, you cannot carry forward.
Yeah.
Business expense. Then interest can be very low.
You're right. So there is always a possibility that you bought some shares today in this year, you haven't sold, you're simply holding it, you not even received dividend. If you were to receive dividend or interest, you could claim any expenditure against that at least. If there is no income then and you have expenditure, then you can't do anything about it. Unless you have F&O, because then F&O part you can at least show it as business income. Against that you can claim. So I'll come to that. Let me just comparison. Now this chart shows that ultimately if you there are two slides. If you compare these modes of investment on these parameters, you will be convinced that the best way to invest is mutual funds, and that's what I have highlighted. And that if you see whether it's tax rate or what is the timing of tax, I have put the advantages and disadvantages in various columns, but whatever I have highlighted in red is what highlights that as compared to other modes of investments. In case of tax, the tax is highest because of surcharge. As I mentioned, that the fund pays tax and they apply highest rate of surcharge. On other parameters, as you can see, the last column I have shown in green, which shows that on these parameters, mutual funds are the best. Because in mutual fund, you pay taxes only when you take the money back. In case of PMS and AIF, you pay taxes as and when the fund is earning, even if the fund is not paying you any income. So imagine that the fund and the PMS has earned profits, they are not giving you the money and you are paying tax. That means tax is being paid out of your own pocket for the moment. I mean, because to the lying with them. So therefore, taxation from the timing point of view, mutual funds are the best. Similarly, taxation even when NAV is negative, mutual funds are the best. Frequency of tax compliance by mutual funds are the best because you don't do any compliance till you get your money back. On other remaining, I have again mentioned that from the point of view of deduction of management fee, like Aditya, we talked about deduction of management fee from various expenses. In case of mutual fund, it automatically gets deducted.
Adjusted in NAV. NAV is adjusted for that.
It is adjusted of all the mutual fund expenses. Not only management fee, but any kind of expense. So therefore, indirectly, you are paying taxes only on profit. That is for a different reason that they anticipate that.
No, I'll explain.
I'm just tax and regulatory compliance and either the compliance or the headache or the things like this.
AIF crowd is different actually. AIF crowd is completely different.
Yeah, I mean there are AIF and the money is higher, risk is higher, and therefore they expect better return. So therefore, I'm not touching the return point of view. I'm not advising from an investment point of view as to what will give you better return. But these are the aspects nobody typically highlights. A wealth advisor will never highlight these aspects at all.
But normally it is understood that HNI and all will be happy with something like 12% return. They don't want to take too much of risk because their capital is more. So 12% is quite significant. Whereas, like other people, like, then they will like to have more returns and all. So they possibly go for a mutual fund. Now, my understanding is that HNIs and all, they are happy with 11-12%. So in that case, suppose that 1 and 2, if they are put in, unlisted, then the earning will be well when the company gets listed, or somebody can have a secondary share, or the internet. I mean, some way. So it will be that consuming risky also. So there will be some returns, but some return may not be like Reliance is wanting to take buyback, those unlisted shares of retail. So those kind of things. So office are not directed. But I understand that they would be happy with 12%. That's why PM is doing much better.
No, I think it's on the contrary, SEBI looks at it very different. So SEBI assumes that HNI, therefore they are educated enough to take risks, and therefore PMS and AIFs are considered to be high risk products and they are high value. And there are less in terms of disclosures, etc., as compared to a mutual fund. So a mutual fund can be public; they can come with an IPO like an NFO, whereas AIF does not come with an NFO.
Completely private placement
for public participation. So therefore, it's privately reached out through the distributor. The way SEBI looks at it is very different. It's not about how much return you expect. On the contrary, these are supposed to be generating higher return. So HNI does not necessarily be happy with 12. A different angle altogether.
One question: how does category 3 AIF hold vis-a-vis the PM?
Same through distributors.
Yeah, through distributors. But what is the difference? I have to invest 1 crore. The fund is bloody paying the tax. So I am leading.
Yeah.
There is not much difference between the return which I will get in the category 3 AIF versus a PMS or anything. So how do the fund manager go ahead and sell this to HNIs or whoever they have to?
Yeah, so typically the same. So typically the same fund manager will not come and tell you that we will invest in the same.
Let's spread a little
either in the PMS
or in the AIF route. They will typically advisor will tell you that we have this Abacus AIF and we have IFL PMS and so on. So they will tell you completely different fund house products. But as you rightly said, is right. It's just that
doesn't make sense to me. I will rather go for a PMS if I have to go then category 3 AI.
So for a manager,
Cat 3 trading, sir.
Manage because for PMS they have multiple compliances. They have to open, whereas AIF is like any other mutual fund. So therefore, they would want to promote mutual fund. So I'll come to the last slide. By the way, this last bullet point is a practical learning I have again, that if you are investing in multiple funds, then CAMS gives you a consolidated capital gain statement of all the mutual funds, all the fund houses. They'll consolidate Kotak, HDFC, blah, blah, and they'll consolidate. But there's no such facility or feature if you are investing in multiple PMS or multiple AIFs. So this is one more advantage of investing in mutual fund. And last slide is some other practical aspects of how one should go about complying when you are investing. The tax portal gives a report in the form of 26 A's for last several years, as everybody gets this report, which gives the details of TDS and income generated. Now they've started giving AIS and TIS also, so that which lists all the transactions that you enter into, which are linked to your PAN. So every time you buy a house, every time you sell a house, you buy shares, whatnot, and all that gets consolidated. So that helps you preparing the data, but that doesn't give you a ready-made capital gains. That is something that you still have to prepare on your own, and therefore, for the same reason, pre-filled ITR forms are also not reliable for capital gains. There are no data on capital gains. We are still far away before the government starts sharing capital gains with all the taxpayers. Because currently there is no mechanism way one can calculate capital gains at the tax level. And the reason is that though government instructed NSDL to start providing capital gains to all the taxpayers, but capital gains also needs to take into account all the costs for calculating capital gains, which are not available with NSDL. For example, the last leg of trading on the stock market, the contract that you get from the broker, and that contract that shows what is the brokerage, stamp duty, and other costs. So those are not available to a depository or a broker. Similarly, the reports which are provided by different brokers, mutual fund, PMS, and AIFs are to be thoroughly reviewed, because I have seen that often brokers' reports there is no consistency. Some brokers don't give you quarterly breakups. Some brokers deduct adjusted STT, which is not deductible for capital gain purposes. So therefore, they have to be reviewed from independently by the taxpayer or the taxpayer. And lastly, as I mentioned, reports provided by CAMS are useful. And there are some private softwares available in the market which generate capital gains, and they consolidate contracts from various brokers. So suppose you have 5 different brokers, Kotak Security, ICICI, other brokers. If you use this software, then all those contract notes are automatically uploaded, and the transactions are consolidated, and you get a capital gain report exactly as per the requirements of the law. Means following FIFO, long term, short term, and various other. So those are the software one can use.
Earlier years, contract notes will be uploaded, because suppose you bought something 3, 4, 5 years back and selling now.
Yeah. Well, which you have reported in the previous years. So you're right. If you're holding for long, then you have to upload, obviously, because the software has to have that. But otherwise, brought forward losses and all that will be from the return. So that's all I had.
Pinned money and others. Pinned money, if you are from CAMS only, and they give, so they relative kind of.
Yeah, so they not direct stocks.
Not direct stock. Direct stock you have
CAMS
to
covers only the mutual fund.
Mutual fund. And direct stock you have to input it.
Yeah. So there are these softwares available where you tell them they have designed software in such a manner that they can pick up 300 to 500 different brokers. I mean, they have designed their template in such a manner that it picks up the fields automatically and then automatically consolidates all the data. Otherwise, if you use a software like Tally, then for each stock you have to open a separate ledger, and you'll have to do the consolidation at a manual level.
I have one fundamental question. So as far as filing of the income tax return, many of the brokers have given the prescribed report of short term, long term, and everything. Okay. So being a chartered accountant, I prepare my own risk fund calculation also in my firm. There always be a difference from year to year. I am doing this. 7-8 years. So what are the calculation done by that software, particular any software like I can say that zero. So I find always there is a difference. Maybe the in calculation of short term, long term, and my records. But since this has been given by the software and it is easily available, so I prefer by going by that software report and uploading it. But in the inside, I know that this calculation is wrong because I am also keeping my own record with the penny of the tallying on 0 paisa also. So now the fundamental question is that I have faced the scrutiny for almost 2-3 years to the IT office also. So I am not in practice, but I prefer IT is my always the income taxes my liking subject on that. So I go to us for the assessment also. So when I produce my record to that particularly IT officer, so he has not taken that. He says that कि boss आप वो system वाला report लेके आओ जो zero से मिलता है या जो भी, and he is going by that record. So now the question is that who is right? Means whether the system report right है या जो मैंने खुद का calculation किया है जो पूरा by to by tally हो रही है.
And one point coming in is system by different brokers is work out differently. You know, there's different than ICSI Direct or Access, you know, they have differences when you see.
Lakhs rupees also.
And sometimes you got share in IPO or say right issue.
Splits, demergers, there is a lot of complexities.
Demand balance, they won't be able to know the cost and all.
Right.
नहीं और जहाँ पे वो split होता है, bonus होता है, वहाँ तो है वो पे पूरा, जो system जो करता है वो.
See, for you, the primary record is the contract which you get. That's the primary record. After that, I think so long as you are able to demonstrate that record that your workings are tying up with those records, primary document is contract.
No, that I agree, sir. But the problem is average cost. Average cost, quantity. The officer doesn't have time, and they don't have even that one also to understand it. You know, many of the IT officer don't know the what people. That is a challenging job. So
Presentation card.
काम वो easy कर देता है कि बॉस वो लेके आओ रिपोर्ट वही छाप के मैं उसका असेसमेंट कर दूँ बस खत्म. कैसे एड्रेस करना है कहाँ जाएंगे उसके
I think we'll have to tackle with the.
नहीं टैकल क्या मैंने तो पूरा मत्था फोड़ लिया आईटी ऑफिसर के साथ सर बोला आप जो
I think you come here.
होंगे देखो मेरे पास पूरा रिकॉर्ड है यू गिव मी दिस वन वो बोलता है नहीं भाई नहीं होगा सीधा बोल दिया.
We'll have to dispute. I think you have no choice but to go for.
चॉइस नहीं मतलब कहीं तो भी उसको करना पड़ेगा ना बिकॉज की अभी जो रॉन्ग है ना बॉस मैंने भी मेरा रिकॉर्ड मैंने तो पूरा रिकॉर्ड प्रोड्यूस कर दिया एक्सेल पूरा प्रोड्यूस कर दिया उसके साथ सारे कॉन्ट्रैक्ट्स भी लगा दिए कि बॉस ये पूरा चेक कर ले जाए तो.
But this working on appeals. Have we to follow first in first out? Yeah, we can decide.
No, it has. For dematerialized shares, it has to be FIFO because you can't identify which shares you're buying. If they're demat, they go into that demat shares are like a bank account. Once you put in money, you don't know which money you're withdrawing. Therefore, CBG has said it has to be.
When I do capital gains, I know my cost. When a concept
In demat, how will you know? How can you prove?
No, you don't know. You don't know your cost. It is a standard thing. The only option is allowed. You don't have to combine all the demats. Only from the demat it is sold. The FIFO is there. Acha, we have lots to go. The role of a CEO, changing role of a CEO, and we will take that. One important question while the setup is being done for the next presentation. One important question addressed to Sunil and Naresh and also Sunil. Gift City transactions, I am saying particularly from 3rd of July, it happened. So there are two aspects. One is there is a feeling it will increase a lot of opportunities for professionals, the way it is going on. From Singapore, it has shifted. Now, one specific question is there. Now, futures that SGX Nifty has shifted to Gift City. Another thing is the shares of top US companies would also be traded here. But what brokers are saying They are saying we already have a tie-up with BSE and we are already doing it. You can buy Googles and Amazons. It doesn't make a difference. They say I have to keep one person there and pay him X salary because that is a decision of a gift, right? Requirement. And then possibly if I keep a person, so JP Morgan may offer double the salary to him. Or how do I monitor it? Because small teams are required. You don't need more than 2-3 members and offer him double the salary. But I have a tie-up with BSE. And today, ICICIdirect.com, HDFC Securities, Access,